RIN TV coverage of the 2015 European Insurance Forum is brought to you by the Dublin International Insurance and Management Association. The international debate over base erosion and profit shifting continued at the European Insurance Forum in Dublin. The Organisation for Economic Cooperation and Development published BEPS in July 2013 to address perceived flaws in international tax rules. The 40-page action plan was endorsed by G20 leaders, and work on implementation is to be completed over the course of 2015. We spoke with John O'Leary, a tax partner in financial services at PwC, to gain some insights into the potential impact these tax rules could have on insurers and reinsurers.
In terms of what the OECD is trying to do is deal with perceived flaws in the international tax regime. And if we look at this, really look at the background, this was really driven by the G20. Coming out of the financial crisis, the G20 was very much dissatisfied with the international tax regime. The view was that global multinational corporations were not contributing enough. And so the OECD was charged with dealing with this. So the OECD really defined the problem as being double non-taxation. And really what that means is that situations where perhaps you have income that's not being taxed in two jurisdictions. Also, another issue is the misalignment of profit and substance. So you have profits arising in one country, and you have the substance in a different country. OECD really not very happy with that. So at a high level, these were the flaws in the international tax regime that the OECD was charged with addressing. In terms of the OECD action plan and how it's going to impact on business, I think it's going to fundamentally impact on business in many ways. What we're really talking about is multinationals, cross-border business, and how they operate. It's a 15-point action plan, so it's really looking at redesigning the international corporate tax system. If we look at some of the key ones, we have defining when you have a taxable presence in another country in which you're doing business. It's going to be much more difficult to be selling cross-border from here on without having a taxable presence. The OECD is focusing on interest deductibility and restricting that. Particularly interest which is being paid to other group companies. That's going to be a really important for many groups. We look at areas such as risk and capital and other areas such as controlled foreign company rules. They're going to change, and they're going to impact on many industries, including the insurance industry. If we look at the BEPS agenda and how it's going to impact on international insurers and reinsurers, I think we can probably focus on a couple of major areas. If we look at international reinsurers, they're all doing business across border. Many of them are doing business on what we call a freedom of services basis, so without necessarily having a presence in the countries in which they're selling. It's going to be much more difficult to do that going forward. When we look at freedom of services structures, when we look at MGA structures, when we look at rep offices, sales functions, all of those are going to have to be looked at to see, do they give you a taxable presence or result in more profit being sucked into the markets in which you're doing business. The other area is risk and capital. Risk and capital is really fundamental to the insurance sector. And really what the OECD is saying here is that risk and capital on their own cannot drive the location of profit. That risk and capital has to be backed up with substance. And when we talk about substance in an insurance context, we're really talking about key people functions. We're talking about underwriters. We're talking about the assumption of risk function. We're talking about the management of that risk. So it's location of the people around those key activities aligned with risk and capital that's going to drive the location of profit going forward. Certainly this is what the OECD is saying. There is some talk about a carve-out for the insurance sector. We'll have to see if that comes true. Obviously, if it did, it would be very positive. So really, I think they're the key areas for insurance. There are some others which will also impact around access to tax treaties and interest deductibility, and indeed, they are going to impact on insurance companies also. Risk and capital and having a taxable presence in foreign locations, they're the key issues, I think, for the insurance sector. There will be others around restrictions on interest deductibility and around controlled foreign corporation rules. And I think all of these are going to have to be looked at, and will certainly, I think, mean all international reinsurance groups will have to review their operations, review their footprint, and look at where they have their key activities to make sure that they are aligned with the BEPS agenda.
For more of our coverage of the 2015 European Insurance Forum, visit the DEMA website or the special 2015 EIF channel in the RIN TV On Demand library.